Stock review. YouTube Finance's favorite show where we review stocks every single month and give you ideas that you might want to look at. So today, me, AK from Fallible, I have 3 new stocks for you for February. But before we get into that, make sure you check out the FOMO trading guide that we put together. It's a free guide that will teach you how to avoid feeling FOMO while you're trading. I've been hearing a lot of people complaining about how they missed this recent rally. They're stressed out and now they're jumping into their stocks maybe a little too late. They're breaking their plan, they're not doing what they're supposed to do. So I want to plug this guide one more time in case you haven't signed up for it already. But now on to the stocks. Now the first thing I think we should do is probably review the stocks that I talked about last month, see how they're doing. Now the first stock I mentioned last month was Tesla, which I got in on November 1st right here. So from then until now, minus 13%, ouch. Looks like I'm actually down about 11.5%. But when I got in, things were looking okay and we were moving up, and then we went through some rough times, especially recently after Elon announced those job cuts, which investors were not happy about. But in the last 3 stocks for January video that I released, that was December 18th. And of course, the day I released it is the day that Tesla started dropping, as you can see here. But when I released that video, Tesla had the highest TSI rating out of the entire NASDAQ 100. They had a TSI of 19.6, which was super strong, especially considering how bad the market was acting during that time. You know, that was right before we got that steep drop going into Christmas. Now, for those of you that don't know, I trade a momentum system called the NASDAQ All-Stars. So the way it works is that it takes the NASDAQ 100 and ranks all the stocks based on their momentum, and it gives them a number called a TSI reading, and the TSI just stands for trend strength indicator. Now the way we calculate that is proprietary, but most measurements of momentum come down to regression analysis, and then the difference on how different people do it depends on whether they're looking at a 30-day look back, 60-day, or 90-day, or even more. But we rank stocks and we get a nice little table like you see here. Highest TSI on top, lowest on the bottom. So like I said, Tesla had the highest TSI of 19.6 back when that video was released, and the system works by once a month rotating into the highest TSI stocks, so the stocks with the most momentum that are moving. Now if we look at Tesla's TSI right now, it's all the way down at 21, a TSI of 4, so not great. Obviously, as you can see in this chart right here, momentum has been beaten up pretty bad. Now when the rotation period comes in February, we'll likely be exiting this name because it's dropped so low on the momentum list. But then again, Tesla has earnings January 30th, so anything could happen. And in situations like that, we kind of wait until after earnings. We might not rotate just on the first day of the month. But we'll have to see, but my bet is I'll probably be getting out of it. Now the thing I did like about this position is how wide our stop is. You can see right here our stop was at 287.52, which is right around here. And this gave us enough room to hold on to the stock during all the volatility, so we weren't booted out. Like if earnings are really good on the 31st and the stock jumps, well, we'd be happy that we were still in it. And there are numerous times, not in Tesla specifically, but in other stocks where over the course of a month, you'll be down 10% and then up 15%. Now that doesn't normally happen, but with the way markets have been in 2018 and now, it has been happening more. So wider stops have actually been better for us. And now in this specific Tesla case, maybe shorter stops would have been a little bit better. You could have cut the losses a little shorter, but you don't want to just look at one trade. You want to look at your entire system. You know, you want to look at all your trades over a full cycle and see which works better. And for us, wider stops, much better. Next stock, which isn't really a stock, is bonds, TLT. So I got into bonds here on November 21st. And then that video came out right here on December 18th. And from there, bonds went all the way up here. Not bad. And we actually took 1/3 profits on this day right here because bonds hit their target. And then for the rest, we got out on January 9th right here. And this is when that system was telling us to rotate out of bonds and back into cash. Now, this system is not the same as the NASDAQ All-Stars. It's a different system called the alpha rotation. And this just rotates between bonds, Qs, and cash. And this specific trade that it did just pretty much killed it. Almost got the bottom and did get the top. And this is just a great example too of taking your profits at your predetermined target. I personally like a strategy where you kind of leg out of a trade. Keep taking profits off the table as you move higher and higher. So in some situations, you're gonna take money off the table when you're right at the top. In others, it's gonna keep on going. Either way, you're getting money in the bank because they're not actually profits until you sell the thing. Paper profits can disappear like that. Again, especially in markets like right now. So you definitely wanna be following your system and taking profits where you need to. Okay, next stock. And this one's actually a stock, Workday, WDAY. This is the one I won that award for, you know, the worst stock in the world. Where's my trophy? All right, it's not here. I'll bring it next time. But I got into Workday right on December 3rd. And as I figured, it was right after a big earnings announcement where the stock jumped. I didn't think it would go higher from there. I imagined that it would consolidate a little bit, which is exactly what it did. And in that video that I released on December 18th, which was right here, Workday still had a very high TSI of 15.84. I think that was the second highest TSI rating right underneath Tesla. But of course, as soon as I released that video, the stock dropped. But again, here's the benefit of having wider stops because it rebounded pretty hard. And I said in that video, if I wasn't a trading assistant, if I was discretionary, I would wait to see the stock break above this consolidation, which is exactly what it did a few days ago. Now, if I had to guess, I would imagine that the system is probably going to stay in this name going into February. And we can see that because Workday is now #1 on the TSI list at 16.2. What that means is that Workday still has a lot of momentum behind it. And with that recent breakout, it's pretty easy to see that. There's a pretty big dip, as I said, but right now we're up about 4.3% in Workday. And like I said, we're probably going to hold that. And you know, that's actually the problem with these 3 stocks of the month videos, because I don't have 3 new stocks every month. A lot of times I'm just holding what I've had for a long time, which isn't as fun. I mean, it's kind of boring, but it works. You know, if you ask any professional investor, they'll tell you one of the hardest things to do is sit in a position. But that's exactly what you need to do to get those huge compounding returns. You're not jumping in and out of stocks month to month unless you have to. The longer you're in a stock, usually the better it's performing. But now let me tell you a new stock that wasn't in the last video. XLNX, Xilinx, I think, Xilinx. Oh, here we go, pronunciation, that's what I need. I swear to God, the hardest thing about video is having to pronounce all these names. I did not have to do it when I was writing, but Xilinx is an American technology company. Basically, they make semiconductors, and they also invented the field programmable gate array, which I don't really know what that does. I kind of know, but not really. And I mean, this is just one more reason why I like trading off momentum, because I don't have to know everything. I can invest in this semiconductor company and not know exactly what they're doing, other than the fact that they must be doing well. And this might sound ignorant to some people, because you know, you got guys like Peter Lynch and Warren Buffett saying, oh, invest in what you know. Invest in the products that you use. Do you like your shoes? Invest in those. And I mean, okay, it is good advice in some cases. Like if I'm wearing Nikes, yeah, it happens that Nike is a pretty good stock. If I'm wearing Lululemon, yeah, that turns out to be a pretty good stock too. But I'm not gonna be intimately familiar with every great stock's product. And I don't want to be limiting my choices just based on what I know, because there is way more that I don't know than what I do know. So I get what they're saying, but at the same time, I don't necessarily agree with it fully. I like the idea of measuring momentum and seeing where the money is moving and following that money. That's the way I do it. If you're a value guy, then yeah, you do need to be pretty intimate with the company. But I just like to date around, you know? If things don't move forward fast enough, I'm out. Momentum. So Xilinx was another one that I got into on November 1st. And from there, it's been a little bit of a crazy ride. But now we're up about 4.6%, not bad. And when I got into Xilinx, it was at the top of the TSI list. It wasn't #1, but it was in the top 5. And now if we take a look, it is #2 on that TSI list with a TSI of 15. So this is another one that the system is probably gonna stay in going into February. But then again, we've got earnings in a few days, which is really an example of great planning out of me, because it's always smart to release videos right before earnings. No, it's not. You don't know what's gonna happen. So, especially what's been happening recently with these high-flying stocks, if they have just a slight kind of bad earnings report, actually not even bad, just not good enough, they are getting stuck, just destroyed, just stabbed and left to bled. They just fall so hard. So while I think the system will probably stay in it, who knows what's gonna happen tomorrow? I mean, the thing could collapse. It could also just jump. That'd be great. We'll see what happens. And I'm not too worried because I got risk control. My positions are sized in a way where if it does drop, it's not gonna hurt me too bad. So we'll see what happens. I mean, I don't even know when this video is gonna be edited, but when it comes out, we'll look at the earnings. I'll make a note or something in the comments. Just check that out. Now, the last stock of stock review is again not a stock, it is cash. Now I wanted to bring up cash because people treat it like it's not a real position. In my past videos recently, especially the Real Vision one, we've been talking about defense. All these managers are looking at plays that are more defensive because the markets are so volatile. Now that's what experts are looking at, but then when I look at a lot of retail traders, they're not even considering something like cash. It's always like, oh, I got this cash in my account, where am I gonna put it? It's like, no, you can leave your cash in your account. That's actually a position. Like I said before, in that alpha rotation model that I use, it rotates between cash, queues, and TLT, and it will stay in cash for long periods of time when cash is the best option. And the worst is when you get rallies like the one we just did and people are feeling that FOMO. Remember, the FOMO guide, sign up for it. It's free. Just tell me where to send it. Just put your email down in one of the links, either the top of this video or the bottom in the comments or description. But people feel that FOMO and then they start trying to move their cash. It's okay to be in cash. And then also while you're in cash, you could review your trading strategy because you need to have your trading plan together. See, let me show you something. Now the NASDAQ All-Star system that I use, it uses the same TSI rankings, but it uses it in 3 different ways. So there's the monthly All-Stars where you basically rotate your positions monthly. There's the active All-Stars, which is more week to week. You have shorter stops and shorter targets. And then you have an options version. Now I personally like the monthly the best. That's what I want to use because it's low time commitment so I could run my businesses and make these great videos for you. But check it out. In 2018, the monthly All-Stars did 1.77% compared to the benchmark, which is the Qs, which did almost -1%. Now I'm pretty happy with that. It was so volatile that a system that moves as slowly as the monthly will get hurt. So close to 2%, I'm real happy. Now if you look at the active version, which I told you before is more trading with shorter stops and shorter targets, it was up 12% compared again to the QQQs, which were down 1%. Now the reason it did so much better than the monthly, it's all basically the same names that you're investing in, but you're just playing them differently. And that kind of shows you how much of an impact your full trading strategy has over just picking a good name. Because it doesn't matter if you pick a good stock, it matters how you manage that position once you're in it. So in some super volatile market like 2018, the active way of managing worked out a lot better than the less frequent monthly model. Now I don't feel like I missed out last year because the truth is both of these models, they work better in different times. So if you look at the full cycle returns, they give you about the same. The active is a few percent more. So since 2008, the active is 949%. So since 2008, the active gave you 949% return, where the monthly gave you a 962%. So okay, I guess I was wrong. The monthly actually does better over the long term. But you know, it's pretty much the same. Now say if I didn't want years where I made almost 0%, like last year with the monthly, I only made 2%. If I wanted to smooth out my equity curve, then I would combine the two systems. I would take half my money, use it for the monthly, and half my money and use it for the active. And using them together, some years the monthly is going to be way above the active, and other years it's going to be the opposite. But over time, it smooths it out. So again, it's just a personal preference thing. How you want to trade is going to be different from how I want to trade. I like the slower, less involved version because staring at the market more than I have to just drives me crazy. And that's the same thing with this whole video. Take a look at these stocks, do your research, and make sure you plug them into your own process. Don't take my word for it. This is just idea generation. And if you want more idea generation, then make sure you subscribe to this channel and hit that bell for an email notification when our next videos come out. We're publishing a lot more videos now. I'm trying to get up to daily. It's taking a little bit though. But subscribe and I will see you in the next video. Stay fallible out there. Bye.